back in November 67, in Kuwait City. So, the finance ministers reading the morning report from London. The pounds dropped 14.3% in value overnight. His government had 80% of their reserves parked in sterling. London had promised him there'd be no devaluation. Only 2 weeks earlier, the British ambassador himself gave them that guarantee. Turns out those guarantees were a load of rubbish. Over a single weekend, Kuwait cops a hit worth 5.9% of its entire gross national product. It wasn't because Kuwait made a dodgy call. It's because they put their trust in the reserve currency. Now here's the thing not many people bring up about this whole situation. Kuwait actually saw this coming. From 64 to 67, Kuwait had already wound back their sterling holdings from 80% to 62%. Smart financial move, but holding 62% was still enough to do some serious damage. This is the sort of thing that keeps me up at night. If you look through history, every single reserve currency has eventually fallen over. None of them last forever. The Spanish real ruled global trade for 100 years. Then it went belly up. Then the Dutch guilder bit the dust too. It was seen as the most high-tech financial tool in the world at the time, but even it eventually crashed. The British pound, sterling, was the world's top reserve currency for over a century. Then it fell apart. Every single one of them followed the same clear, well-documented pattern. And that pattern always kicks off the same way. The first ones to cop it are the countries on the outer edges, way before the core currency shows any signs of stress. Out on the fringes of the system, currencies go through a few changes. Today, I'm going to show you that. After you finish this vid, you'll be able to spot the 4 signs that came before every big reserve currency crash. Historically, these breakdowns went down in the order I'm about to tell you. You'll pick up on which signs are showing right now and get why they matter. Countries closest to the edge of the current dollar system are already showing patterns that hinted at every past shift. Hang tight before we move on. Just a heads up, I'm not a professional financial advisor. Nothing in this video counts as investment advice. What you're watching is a thorough look at the real historical evidence. What you do with that info is totally your call. First up, let me lay out the pattern that keeps happening. Next, the evidence. When a reserve currency tanks, it doesn't start falling apart from the core. Even though the British pound was still working fine for Londoners, Kuwait copped a 6% hit to its national revenue. The Dutch guilder was still being used all over Amsterdam. When Suriname's plantation economies went belly up under the weight of debts and guilders, they couldn't pay them off anymore. The decline always starts from the outer bits. It's the countries on the fringes that cop it first. Then the damage moves inward. Once it hits the core, the shift's almost done. It's the same pattern and sequence, repeating every time. Here are the 4 red flags you need to keep an eye on. Alright, in order of appearance. Warning sign number 1. The currencies on the edge start to collapse. This is the earliest sign, not the reserve currency itself, mate. So for the currencies of the most at-risk nations, here's how it went down with sterling. Back in 1964, sterling made up 83% of the official reserves held by those overseas sterling area countries. By 1967, that share had dropped to 65%. And in 1968, it fell below 55%. Over that 6-year stretch, sterling looked steady, but countries on the fringes were quietly buggering off. Burma sold off nearly all its sterling reserves in 64 and 65, flogging over 50 million pounds. The Burmese mob started sticking gold clauses into commercial contracts, like timber deals, so they could recover losses if Britain devalued the pound. 3 years before the devaluation, Burma saw the writing on the wall. After its revolution in 1958, Iraq announced it was going to ditch the sterling system. Between 1955 and 1967, South Africa dropped its sterling holdings from 25% down to 3%. India's sterling reserves went from £417 million to £85 million in 9 years, a 5-fold drop. While London's official line said everything was sweet, now have a look at today's situation. The Turkish lira has tanked 80% against the dollar over the last 5 years. The Lebanese pound has crashed 98%, and the Egyptian pound has lost 70% since 2022. In the last 3 years, the Argentine peso has been through a heap of major devaluations. After unification in 2023, the Nigerian naira lost 73%, and the Pakistani rupee has been cut in half. These things aren't happening on their own. These secondary currencies are copping it because of debt in US dollars and commodities priced in the greenback. It's not the dollar that's crook, but these events show you where the pressure in a reserve currency system first shows up, time and again. You can't argue with history. When a bunch of secondary currencies start cracking up like this, it's a sure sign. And right now, you're seeing the first step in a pattern that always ends up the same way. Second red flag. Those secondary governments are sitting on reserves they can't flog off without taking a huge risk. That's the trap, and it's the most dangerous part of the whole cycle. If a country's got a big stash of the main currency, it can't just offload it whenever it wants. The moment it starts selling heaps, it sparks the very devaluation it was scared of. So it holds on, sits tight, and takes the word of London or Washington. But the devaluation still happens, and the losses are bloody devastating. Kuwait had already halved its exposure before 1967, but they still lost the equivalent of 6% of their GNP in just one weekend, because 62% is way too much to pull out on the quiet. Malaysia had the second biggest official sterling reserves of any government in the world. In the weeks before November 1967, when Malaysia asked the Bank of England for guarantees, all they got was a verbal promise. Then, out of the blue, Britain devalued the pound on a Saturday night. The Kuala Lumpur Stock Exchange shut down the following Monday. The trust between London and Kuala Lumpur was wrecked. Any mutual faith just disappeared. As of early 1976, Nigeria still had £800 million in reserves. In 1968, Britain offered a dollar value guarantee under the Basel Sterling Agreements, but only if Nigeria kept 60% of its reserves in pounds. Then Britain just unilaterally canned the agreements. Nigeria called it a serious breach of trust, and they ended up with just 3.756 million quid in compensation, 3 million for holding on to 800 million. What really blows people's minds about this setup is that the trap's all down to maths. The more you're holding in sterling, the less you can sell off, and the bigger your losses when it finally gets devalued. The bloke who issues the reserve currency knows this. That's one reason these shifts take decades, not just days. Those countries on the edge can't just pull out completely. They can only cut back a bit at the fringes, all while hoping the core stays solid. Right now, emerging economies have got about $6 trillion worth of US Treasury bonds and other assets priced in dollars. It's not a question of whether they want to reduce their exposure. Plenty of them do want to do it. The real question is how much they can get rid of without triggering the exact change they're trying to avoid. The short answer is, not as much as they'd like. Let that sink in properly. Third alarm bell. Central banks start hoarding gold when reserve managers lose trust in paper assets and start chasing the real stuff. This is a sign that's shown up before every major reserve currency shake-up in history. Have a squiz at what went down just before the pound sterling crashed. Back in 1965, Charles de Gaulle came out and said that gold was the only real international currency, and he began swapping France's dollar reserves for gold. He even sent the French Navy over to New York to physically pick it up. From 1965 to March 1968, the gold pool, which was a joint gig by the big central banks to keep the gold price stable, copped total losses of $3.692 billion. America's gold reserves dropped by a quarter over 3 years. The gold pool actually fell apart earlier, on the 17th of March, 1968. As the Dutch guilder went through its long decline, there was a recorded scramble for physical coins and solid metal. When people started losing faith in the Bank of Amsterdam's paper system, it turned out the bank had been secretly lending more than it was allowed to. When the public found out about it in the 1780s, the premium that bank money had over metal coins for over a century disappeared in one night. Now, have a look at today's situation. Back in 2022, central banks snapped up 1,136 tons of gold, then 1,037 tons in 2023, and 1,045 tons in 2024. For the fourth year in a row, central banks bought 863 tons of gold in 2025, way above the 10-year average of 473 tons. If you just look at 2022, 2023, and 2024, central banks had already grabbed more than 3,000 tons come 2025. The World Gold Council had a chat with central bank reserve managers. A solid 95% of those surveyed reckon global gold reserves will keep growing. 43% are planning to up their own gold holdings. Not one of them plans to cut back on their gold reserves. In 2025, Poland bought 102 tons of gold, aiming to have 30% of its reserves in gold for national security reasons. India brought back 100 tons from the Bank of England vaults to store at home, while China officially says it's got 2,306 tons. But analysts reckon the real gold reserves are a fair bit higher. History books clearly show this trigger. The US and its mates froze about $300 billion worth of Russian central bank assets back in 2022. Every central bank around the world saw that happen. Each one quietly thought, could that happen to us? You can't freeze gold. Gold can't be touched by sanctions. It's the only reserve asset with no counterparty risk. Do the maths. For 4 years running, central banks bought gold at almost twice the usual rate, even while gold hit 53 new all-time highs in 2025 alone. This isn't guesswork. It's institutional memory right at the top of global finance. Warning sign number 4. Alternative settlement infrastructure shows up. That's the latest stage signal. By the time this sign pops up, the shift's already happening. The fringe damage is done, gold's on the move, and now they're building the bones of a new system. Back before the dollar replaced sterling, the Americans had already laid the groundwork. The 1944 Bretton Woods Agreement created the IMF and pegged the dollar to gold. At the same time, the US set up the World Bank, and American financial organizations spread across the globe through the 50s and 60s. When sterling finally crashed in 1976, all the big countries had already hopped onto the dollar-based system, so the switch was smooth as. Before sterling took over from the guilder, London spent the 1800s building its own clearing systems. Traders already had other options through the London Stock Exchange, the Bank of England's power to print notes, and the Bill of Exchange system, long before anyone realized the guilder was on the way out. It's not like the old reserve currency fails first, and then a new one pops up. The real order of events is this. For decades, new infrastructure gets built quietly, and only then does the existing reserve currency crash. Look at today. China's cross-border interbank payment system processed $24.47 trillion in transactions back in 2024. That's 3 times what it handled 5 years earlier. By the end of 2025, the system had 193 direct members and 1,573 indirect participants from 189 countries. Russia's SPFS financial messaging network now has 177 international participants from 24 different countries. Right now, China and Russia settle 99% of their two-way trade, that's $245 billion a year, in yuan and rubles, up from just 25% back in 2021. The bridge platform brought in the central banks of China, Hong Kong, Thailand, the UAE, and Saudi Arabia. As of November 2025, it had handled $55 billion worth of cross-border payments. In October 2024, the Bank for International Settlements quietly backed out of the project, handing control over to the countries involved. At the 2024 BRICS Summit in Kazan, member countries launched a payment system called BRICS Pay and began looking into a settlement tool known as the unit. This tool's value was tied 40% to gold and 60% to a basket of BRICS currencies. Quick interjection. If you're seeing these trends and wondering what history reckons you should do, go ahead and subscribe. That's been the Independent Financial Historian. By showing the autopsy, I help you recognize the patterns before they pop up again. This is free, mate, unlike financial education, in a system built to keep you ignorant. Now, have a think about the opposite view. To give this analysis a fair dinkum look, you need the dollar. It still sits on one side of 89.2% of all global forex trades. According to the Bank for International Settlements' April 2025 survey, that's jumped from 88.4% back in 2022. Come January 2025, the dollar's share of SWIFT payments hit 50.2%. The renminbi only makes up 2.1% of global reserve assets. There's no realistic alternative currency on the horizon. The shift from sterling to the dollar took 30 years, while going from the guilder to sterling went for more than 50. Changes in reserve currency status are measured in decades, mate. They're not measured in months. But history shows a key thing about that timeline. Collateral damage doesn't stop for the transition to finish. Kuwait copped its losses in 1967. Countries in the sterling area that hung on until 1976 suffered an extra 20% loss when sterling kept falling after it was floated. Nigeria still held £800 million in 1976, 9 years after the devaluation it saw coming. Peripheral nations cop it first, carry the longest costs, and keep paying even after the crisis is over. History doesn't ask, is the dollar about to collapse? The evidence from history suggests this question won't be answered for decades. Instead, history asks, where do you sit in the sequence? And based on all four warning signs, the answer is that the sequence has already kicked off. That's what history shows us. It's weathered every past change in the global reserve currency. Gold comes out on top. Looking at it in US dollars, every shift shows gold went from $35 an ounce in 1971 up to $850 an ounce by January 1980. In British pounds, gold rose from £14 an ounce in 1945 to over £400 an ounce by 1980. Even further back, when the guilder collapsed, when the Bank of Amsterdam's paper notes turned useless, physical metal was the only thing that kept its worth. Second, shares in solid companies that earn money overseas, not bonds or cash, but equities. The Barclays Equity Gilt Study, covering more than 100 years of UK data, found equities gave a real yearly return of 5.1%. While sterling was dropping, gilts gave back 1.2% and cash only returned 0.8%. Companies with assets and income in foreign currencies did the best. Third, tangible assets like land, property, and physical production capacity. Every time there's a shift, people who own productive physical stuff come out on top, while those holding government promises miss out. History shows that government bonds in the weakening currency ended up worthless. Work by Carmen Reinhart and Belén Sprancia for the IMF suggests real interest rates on government bonds were negative. In advanced economies, those rates were negative about half the time between 1,945 and 1,980. For the UK specifically, the real rate on government bonds was negative in 24 of the 30 years after World War II. If you'd put £100 into British gilts in 1945 and didn't reinvest the income, it would have been worth about £2 in real terms by 2014. Not quite nothing, but just £2. And here's the key bit that should worry anyone holding US dollar government bonds right now. The US federal debt hit $39 trillion back in April 2026. Interest payments on that debt hit $1.2 trillion in the 2025 financial year, nearly 3 times the $345 billion in 2020. Right now, we're forking out more on interest than on defense. By 2035, the Congressional Budget Office reckons national debt'll hit 120% of GDP. Back in 1945, Britain was in the same boat, and it took them 30 years to sort out the mess. They pulled it off with financial repression, keeping interest rates below inflation, which slowly ate away at the real value of the debt. Anyone who held on to government bonds for those 30 years copped the cost. If you bother to look, the pattern's pretty obvious. There's 4 warning signs, and every bloody one of them's front and center right now. Currencies in places like Turkey, Lebanon, Egypt, Argentina, and Nigeria are taking a dive. People sitting on preferred reserve assets are stuck with some serious exposure. They can't just offload $6 trillion worth of treasury securities. Flogging them would trigger the whole adjustment. Over the last 4 years, central banks have been buying gold at about double the usual rate, and 95% of them plan to grab even more. There's trillions of dollars worth of transactions going through alternative settlement systems that work outside the dollar system. What's happened before doesn't decide what's coming. The US dollar ain't about to collapse. Swapping one reserve currency for another takes decades. By every measure right now, the dollar's still king. But hey, Kuwait's worries back in '67 were fair dinkum. Kuwait's read on things was spot on. They just couldn't offload fast enough. The question ain't whether this pattern'll end. It always bloody does. The real question is whether you'll be ready when it happens. Same as that Saturday night when Britain devalued the pound. Folks who stashed their cash in an envelope behind the bookshelf didn't have to wrap their head around reserve currency theory. All they really needed was to have something the Bank of England couldn't knock the value off. It's a mathematical pattern, the outcome's dead certain, and the only bloke who can change things is you, so spread your bets now, before you've got no say in it.